Hello everybody and welcome to another video on financial analysis, and in this video we are going to be looking at a company called Proton Motor Power Systems. So Proton Motor Power Systems, what do they do? So here is from their website. They say that they are subsidiary or through their subsidiary in Germany. They've developed and produced a standard hydrogen fuel cell module integrated with energy storage system to create an electric fuel cell hybrid system capable of providing power for mobile, stationary, and maritime applications. I think that basically means kind of engines that run off hydrogen, if that makes sense. Opportunities to combine batteries with their PEM fuel cell system serve markets where electric fuel cell hybrid systems offer considerable advances over conventional combustion engines and engine technology. So this is kind of, a play on green energy and sustainable and, alternative energy. So all sounding quite exciting. So that's what they do, and today we're going to be looking at their financial analysis. Now, just a quick caveat for those of you who haven't seen this channel before, we are looking at the financial statements. The financial statements, by their definition, are backward looking. So if you want to tell me what the company is up to and in terms of latest developments, then please do use the chat. If you want to tell me that this analysis is out of date, you are welcome to do that in the chat, but I already know it. But please do, whatever you put in the chat, please do be polite. So we are looking at Proton Motor Power Systems on a specific request. So I received an email from James. So thank you very much to James for your email. It says, firstly, thanks for a great channel. My pleasure. It says, one of you look at Proton Motor Power. Company made 900,000 of sales, 97k profit, and 3.9 million operating loss. So operating profit, so probably gross profit, I'm guessing. We'll have a look at and just check that. Share price declined since Jan, but has just bounced. The reason I'm asking, okay, now this is a very specific one. The reason I'm asking because there's an embedded derivative loan for a huge amount, and I just don't understand how it works. I'd love to hear the mechanism of it explained. Also confusing is why this contribute to a gain in the interims when it's based on the share price, which declined during the period, including the embedded derivative of the company. Okay, so why it would contribute a gain in the interims? Included in the embedded derivative, the company has 476 million liabilities, exclamation mark. I don't know if it was the same loan or part of, but recently the director's brother also lent some more money through a company which raised a few eyebrows on various bulletin boards. I'll bet it did. I spent the evening looking at the company and at first keen on the company was doing, but after looking into the history a bit further, especially the director selling an apparent milking of the company by converting interest payments into shares valued at 2p and selling for 70p. And so it might just be a lifestyle company or run by the wrong brothers, in inverted commas, how it does employ 99 people and has some high profile customers, which it supplies fuel cells to. I'm sure you get a lot of requests. I understand it's not possible. Keep up the great work. Thank you very much. More AIM stock with small caps. And he gives me a couple of one. Okay, we'll come on to that other one. Okay, so this one is for you, James. You pique my curiosity when you talk about something a little bit interesting in there. So if you are requesting and you want to kind of get up to the top of the queue, then rather than just giving a name, you might sort of give me a little bit of interest as to why you find it interesting. And also the thing I like this about this particular email is that James is talking about, spend the evening looking at the company. So he's doing a lot of research. It's not just he's not just relying on my analysis, which is quite lucky. And remember, obviously, that my analysis is backward looking. We're looking at what happened in the past, and he's talking about what's happening in the future and who the management is and the kind of what they're actually up to. So and this is any value investor, any professional investor needs to do their analysis. They can't just rely on what's going on in the bulletin boards. So without further ado, let's jump into the financials. Before we do, just a quick request. Please do remember to like, share, and subscribe. So do subscribe to the channel. If you do and you get your video appears, then you'll get notification. And if you share, then we'll get a greater following and we'll get more interesting requests like this one from James. So with that in mind, let's go and have a look at the financials. So here is Proton Motor Power System. I'm going to call them Proton from now on because it's a real mouthful. And the annual report and account, this is December 2020. Now, as I'm filming this, it is pretty much at the end of October. So these numbers are very, very out of date. I get it. But if you want to tell me how out of date they are, please do leave a comment in the comment section. Please remember to be polite. Now, in terms of what they do, if you want to know what they do in great detail, then do read the annual report and account. It's available on their website and it's got very, very nice pictures in there. All of them are in color, which is nice. However, we are going to scroll straight down to the bottom and look at the financials. And here we see the numbers. This is the consolidated income statement. Now, consolidated income statement, top line, the sales of this business have more than doubled, up 146%. So that's a pretty good sign. However, cost of sales has also risen and they are trading at a loss. Okay, so the cost of the things that they're selling them at below what it costs them to make. Okay, which is not really a sustainable business model. Now, maybe they're starting to grow. I mean, you'll look at these are in pounds thousands, so sales of 1.9 million pounds isn't particularly large. So there's kind of what we call economies of scale maybe to come. So as they start to grow, the cost per unit is going to come down. We would certainly hope that. We see that the cost of sales in the previous year was 154% of sales. In this year, it's only 104% of sales. So as those sales start to grow, these guys should start to come through to profitability. However, they are operating at a loss at this point, and the administrative expenses, about £7.5 million. Good to see that they stayed constant, even though sales have gone up. However, they still are £7.5 million, meaning these guys are operating at a loss. So operating at a loss, and then they've got the finance costs, and the finance cost is the interest they pay on the debt. So this suggests that they've got this debt, and we're going to come on to what James was talking about later. But on the face of it, that interest has gone up significantly. So that's a kind of a question mark, suggesting that the debt has gone up very, very significantly. And these guys, on the face of it, they can't afford that interest. And then we get this real kind of anomaly coming in here of this fair value loss on embedded derivatives. Okay, and the note 22 is going to tell us a little bit more about that, but we're not going to go and have a look at that note just yet. We're going to hold off and we're going to go and look at the balance sheet first. However, when we include that fair value, and I think it's probably worth just noting that this is an accounting adjustment. So this isn't cash out the door. They haven't bought this stuff. It's an accounting adjustment. Okay, so it's kind of if you kind of I don't know, if you if you suddenly owe somebody £100, that's an accounting adjustment rather than actually cash out the door until you actually pay them. Anyway, but it is a loss, okay, and you can start to see that these guys make a significant loss. And similar story in the previous year with this fair value loss on embedded derivatives. So that's what James was kind of scratching his head and saying, Ted, I don't understand that, and I'm going to hopefully be able to shed a little bit of light on that. But before we do, let's go and have a look at the balance sheet, just see what the company is looking like. So non-current assets look pretty straightforward, 1.8 million. Most of that is property, plant and equipment, so that's absolutely fine. Few intangibles in there. That'll be kind of intellectual property rights, software, a little bit of right of use assets. That's just stuff that they've leased assets. So rather than buying a table, they lease a table, put it in that separate category. In the current assets, they've got some inventory, some trade receivables, and quite a lot of cash, 2.7 million pounds worth of cash. So current total assets look pretty reasonable. Let's just scroll down and have a look at the bottom half of the balance sheet. So current liabilities, quite high current liabilities, that 5.3. When we compare that to the 4877, that's a warning sign for us, especially when we see trade and other payables looking pretty high. Lots of inventory in there. Can they sell that inventory suddenly there's kind of this working capital. Maybe there's a little bit of a strain going on there. So if I plug my numbers into my little spreadsheet, and this is very back of an envelope calculation, my spreadsheet, but it gives me a feel. It tells me it takes them 388 days to sell the things that they've made. Okay, so that's their inventory turnover there. That's basically over a year, okay, which is quite a long time to have cash tied up in there. So they do have a reasonable amount of cash, but they've got quite a lot of cash tied up in their inventory. Looks like they're taking them 57 days to collect the money in. Yeah, okay, so and actually it's probably a little bit lower than that, because I was a bit lazy, and I actually just used the numbers on the face of the balance sheet, and I didn't dig around into the note to the accounts. And it looks to me like the trade and other payables is very, very high, at 4.3, note 19. In fact, you know, I'm kind of thinking maybe we should go and have a look at note 19 and see whether it is trade and other payables or whether it is something else. So let's just very quickly scoot down to note 19. We will come on to note 22, don't worry, James, but note 19 for now. So here is note 19. Quite interesting about this note. So the trade and other payables, the actual suppliers they owe, is actually quite low. We think, oh, that's pretty good. So the suppliers are getting paid. However, just below that, we have other payables, and we don't actually tell us what other payables are. But this is where companies such as Proton can hide the amount they owe to their suppliers. So you may remember Greensill, who recently went bust. And effectively what would happen is that, you know, they were a finance company. So Proton would effectively say to Greensill, you pay my suppliers and then I will pay you. And what they do is that then they can take it out of the trade payables, because the trade guys have been paid, and we stick it into other payables. So it's a form of financing. So, you know what, I'm gonna stick to keeping those two together, because that is effectively just using a separate finance company to pay their suppliers. And you'd only do that if you had a few cash flow issues. So that means that they are paying in about 1,000 days. So it means you the supplier, you're going to get paid early, but these guys are not are struggling with that payment, and that's kind of reflected in that liquidity ratio. So that's kind of our first warning sign before we even get close to the this derivative thing. So what else is going on in the balance sheet? Well, we've got a reasonable amount of debt in here. So here is the debt. Let's just point it out. So we've got some borrowings. Don't worry about the lease. So the lease debt is, you remember we had those right of use assets sitting just outside. You can't quite see it here, but just up in the non-current assets somewhere up here, we've got the right of use, and that's the lease attached to those right of use assets. But what we are interested in is this is the short-term borrowings. And if we see here, we have a very, very large long-term borrowing. Okay, so these guys have a ton of debt. Now, even if you ignore this number here, they still have a ton of debt. They have a negative balance sheet, because if you've got 6 million in assets and 80 million in debt, you are technically insolvent. Now, you're not actually insolvent as long as you can continue to trade and you can continue to pay your bills as they fall due. But these guys have a massive negative balance sheet. In fact, I haven't seen a balance sheet that negative since Liverpool in about 2009. So not looking too good. Let's go and have a look at the so the balance sheet is really and again, you know, we need to kind of understand this debt, because if it's from related parties, you know, if I'm a shareholder and I'm owed money, then, you know, I kind of maybe a bit of a conflict of interest. Do I want to get my debt out? Well, you're not going to get your 79 million out, because there aren't the assets there to get it out. So these guys effectively, you know, they're sitting there facing a haircut, and they're going to have to ride out the storm, the debt provider. So even if it's a related party, even if it's like a shareholder who's lent money in, you know, they're going to have to wait it out to try and get that money out. So here is the equity side. And they've been making, so there's the loss for the year and the retained earnings. So they've actually put through the loss for the year as at 31st of January, and the loss during the year. So a little bit of sort of funding coming in there. Let's go and look at the that's the company balance sheet. Not too worried about that. Not really worried about the accumulated losses. We just know that there are big losses and there are no dividends, as you would expect. Let's go and have a look at the cash flow. So cash flow, pretty important. Okay, and here we see cash flow, negative cash flow. Okay, now we've got a big positive movement, which is this movement in the embedded derivative. And as I said, that's just an accounting adjustment. So a little bit like depreciation, we add it back. So what looks like a really, really, really big loss is only a kind of a normal size loss. And I think the way to think about this business is you have to take that and just that embedded derivative amount and just put it on one side for now and look at the kind of the normal numbers. So it's losing cash, and losing cash is definitely not good. And if we think about it losing cash and how much cash does it have at the end of the year, and it's only got I said it had $2.7 million pounds in cash, which I thought was pretty good. But if you're burning £4.7 million and you've only got you can suddenly see these guys, they're going to have to go somewhere in order to get some more cash, and maybe they're going to go to the equity shareholders, maybe they're going to go and borrow some more, as our friend James pointed out. One of the I think the brothers had put some more money in, and maybe that was since this balance sheet date. Anyway, investing activity, so a little bit of investing going on, as you'd expect with a company like this, bit of PPE being bought. And then here we've got the financing activities. So the issue of loan notes. So they are increasing their debt. They are issuing new shares. So they are going to the equity markets and they are selling shares. They're doing rights issue. If you're a shareholder, you are probably getting little notes saying you have the right to buy, etc., etc. And then there's a little bit of repayment going on here as well. Anyway, the net effect is that they're raising cash from financing it, and that raising cash is primarily coming from both the taking out loans, issuing more shares, and that is why while they are burning cash up here, they've still got cash in the bank. But this will not be the last time that they go to their shareholders and say, we need some more money. So there is the kind of, the core analysis, but I still, I can feel James tapping his feet going, come on, let's go and have a look at note 22. So come on, let's go and have a look at note 22 and see what is going on with this debt and these borrowings. So down to note 21 and 22, and here they are. Now, 21 talks about the borrowing. So here are the borrowings, and we've got the non-current borrowings, as we said, of about nearly £80 million, okay? And that is a lot of money. And there's a little bit of information there about the loans. And there's a few things that kind of jump out at me. The principal loan attracts interest of 10% per annum. 10% is a lot. I mean, I know this is a high risk company and the lenders are taking on a lot of risk, but even so, 10% is quite an expensive loan in a world where the base rate today in the UK is 0.01%, the lowest it's ever been since 1694. Then it decreases, it says, to LIBOR plus 3%. That's so the London interbank offer rate, which kind of sits basically just above the base rate from January 2021. So it's now kind of got a lot cheaper. And it'll be sitting around about kind of 3 or 4. I don't know what LIBOR is today, but it's probably about 0.5%, something like that. So I'd expect it to be about 3.5%. And then this is the point. It says it has the option to convert a capped amount of the accrued interest at any time into ordinary shares in the parent company at a set rate per share. Now, they don't actually mention what that set rate per share is, okay? But basically what they're saying is that they can take the interest and they can convert it into equity. So not the debt itself, but the interest. So the interest is building up. The company isn't paying the interest. They're not paying the interest because they can't afford it. So the interest is effectively accruing into the loan as a kind of, so that's effectively why the loan is going up. And I guess that they're paying interest on interest. So if you don't pay the interest, it becomes a liability, and therefore your liability goes up, so your interest goes up, etc., etc. The wonderful world of compounding, which I think was described by Einstein as the 8th wonder of the world. It works very well for you if you are investing, and it works very hard against you if you have a lot of debt, especially at a high rate such as 10%. Subsequent to the year end, we agreed to extend this loan facility by further 5.9 million from 20 to 26 million. What else we got here? So some other bits and pieces, so inter-party amounts, and I think this is the point. Mr. Falil Nahab, the brother of Dr. Fazil Nahab, the director of the company, and so they're disclosing this this loan here. 49, so that's about 50 million pounds. They're kind of jumping between euros and pounds for some reason. I'm not sure exactly why. Again, we've got this 10% of interest. And again, Mr. Falil Nahab has the option to convert a capped amount of the accrued interest at any time into ordinary shares in the parent company at a set rate per share. And I'd be very interested to know what that set rate per share was. So, and again, we've extended it up to 50 million. All loans are secured on the assets of the group, but as we saw, the assets, the group has no assets, or certainly hasn't got 80 million pounds worth of assets. And the redemption rates have been extended to 2025, so that they are now non-current. So this embedded derivative, it kind of makes it, it uses things like the Black-Scholes valuation model, which is certainly beyond my pay grade, I can tell you. But the last time I saw Black-Scholes being used, it was by the LTCM, which went bust in about 1998 with $3.6 billion worth of liabilities. But Black-Scholes is just an options pricing model, and basically it's saying that you have you lend some money, you earn some interest on it, you have the right. Okay, this is an option. You have the right, not the obligation, to convert that interest into shares. Now, in effect, what will happen is that if you don't think the company is going to do particularly well, you say, I'm not going to exercise that, and therefore I want all of my money back. And then you take the money through take the company through the courts, put it into liquidation, and effectively you sit at the front of the queue. So you are owed money, you are a creditor of the company, and you sit at the front of the queue in front of any of the equity, any of the shareholders. So if there's any money left over, and there clearly isn't going to be, but if there was any money left over, the shareholders would get the rest. However, if they do exercise that option, then all of that interest, that liability we've seen, effectively converts into equity. So let me show you what I mean when we go back to the balance sheet. When we look at the balance sheet, and we can see the consolidated balance sheet. Here we go. So when we look at the consolidated balance sheet and the liability side, in effect, what happens is that we take this number here, and this is essentially what we're going to do. We're going to take this number here and we're going to stick it down here. So in effect, this number here now goes up by 609, and this number here goes down by 609. Now, you'll notice you've still got a negative balance sheet, okay? But it's not as negative, it's not as disastrous as it is at the moment, okay? And that's effectively what they're proposing to do. So, at the behest of the person lending the money, they can convert it into equity. So if you think about the scenario, the company starts to do really, really well. And if I'm the lender and I'm looking, company's doing really, really well, that's fantastic. I'm going to convert my interest into equity, and therefore I'm going to take an equity interest. Now, you've got to remember, of course, as an existing shareholder, that this means that you have a massive shareholder suddenly enter into the room, and effectively you get diluted out of existence. So if you want to know exactly what that looks like, watch the Social Network all about Facebook, and watch the bit where the CFO gets diluted out effectively. So that's effectively, if I was buying a share in this company, I'd be sitting there thinking, if the company goes bust, I'm not going to get any money. And if the company does really well, then whoever owns all of these embedded derivatives is going to exercise them, because why wouldn't you? And therefore, effectively, my shareholding is going to go from, a reasonable amount to something which is tiny, 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 tiny. And we don't know, I haven't looked in detail, but it certainly wasn't explicit as to what the rate is. So exactly how many shares this convertible interest will effectively buy, and what effect that will have. Is it at well, it won't be at the prevailing rate, it'll be at a rate agreed when the option was put in place. And therefore you can start to see that an individual has the option effectively to buy shares at rate. So let's say they agree at and I don't know what it's trading at because I haven't looked at the share price yet, but if the shares are trading today at £5, then the option may have been granted at, I don't know, £1, for example. So here is an individual, they have the right to convert them at £1, and then they can sell them at £5. They may have the option at £10, in which case they're not going to convert them now, but once the share price gets above £10, then they will convert them. So the exercise price is very, very important. And then you start to think about, so where does the company buy those shares for it in order to give it to the individual? Well, obviously not. So what the company would do is to create those shares, and effectively that's going to dilute any existing shareholders. So you're going to see a massive increase in equity, but no cash. And that's basically, as far as I can make out, what's going on. Now, I may be 100% wrong, and I'm happy to be 100% wrong. I've been wrong before, and I will be wrong again. And if you think I'm talking absolute rubbish, then you are welcome to leave your comments in the comment section. But once again, as I always say, please do it in the most polite way you possibly can. Otherwise, there is my analysis of this business. So let's go and have a look at their share price anyway. We did say that we do that and see what's going on with the share price. So here is their share price. It's been bouncing around quite a lot. And then in 2019, it started to go all the way up and then all the way back down again. And I'm guessing that that's where kind of some of these loans has come in. It looks like it's, for me, it's got a P ratio, so it must be making a profit now, because it certainly wasn't in 2020. So it must be making a profit. The market capitalization is, well, it's a massive negative balance sheet. So inherent goodwill is pretty irrelevant in that kind of calculation. I put it this way. This is definitely not one for me. I'm not in the least bit tempted by an investment in this organization. So there you have it. There's our analysis of Proton Motor Systems. I hope you found that useful and interesting. Thank you very much to James for recommending it. And once again, as I've said before, please do like, share, subscribe. If you would like me to look at a company, then do let me know. Just drop it in the comment section. If you give me a little bit of a background, a little bit of a feeling as to why you want me to look at the company and what you've been digging around, finding out maybe something doesn't quite make sense, then it usually gets me to usually piques my interest and gets you to the top of the pile. Anyway, thank you very much for watching. Hope you found it useful. Like, share, subscribe, leave any comments in the comment section, and I will see you on the next video.